Much on expected lines, the Monetary Policy Committee kept benchmark interest rates unchanged this time around. They also kept their stance unchanged at calibrated tightening. But the inflation forecasts for the second half of this year and the first half of next year have been trimmed quite considerably, perhaps leaving the room for at least a move back to the neutral stance, and then maybe if inflation supports, maybe to a turn in the rate trajectory as well. Let's actually ask our experts on that. Joining me here on Bloomberg Quint is Saugata Bhattacharya, Chief Economist at Axis Bank, and Sajjid Chinoy, Chief India Economist at JPMorgan. Thanks both of you for joining us here on Bloomberg Quint. Saugata, let me start with you. And I saw your pre-policy note and you said there is a justification to move to neutral stance. They haven't done it this time, but they've in some ways laid the groundwork, right?
I'm not very sure. Did I say that? I mean,
yes, you did.
No. I mean, so obviously, I mean, with inflation being what it is and what we expect inflation to be, given the extent that we know where we are heading. So obviously, I mean, there is some room for but remember, I mean, you know, no central bank anywhere in the world would change stances between one policy and the other. You know, I mean, stance is something which is a more durable construct, metric. And given the amount of risks that exist in the system, I mean, just see the near-term risks. I mean, you know, the Brexit thing, Iran, the OPEC meeting tomorrow, then the US-Iran trade talk, US-China trade talk, whole bunch of events can switch things overnight, any which way. So I don't think there was any realistic prospect of shifting the stance. And remember, come what may, at the end of it, we are hopefully in a growth upturn cycle now. So given that, the next hike, we might be on an extended pause for God knows how long. I have no idea. I mean, how things will turn out. So even if inflation falls, corporate pricing power might be coming back. So my sense is it was very, very premature at this point in time to even talk of a stance change. And the provision of liquidity in the system is finally what matters to borrowing costs. And we haven't seen any direct overt measures today, but I mean, I'm sure they've given all indications that they will fill that liquidity gap, whatever that gap may be.
Okay, so Sajjid, what was your sense of what came through? Was it broadly in line with what you would have expected given the data available?
I would think really no big surprises here. Two things stood out for me. One is that the central bank made very clear it's going to be data dependent, and that 4% is what it's after. And what I liked is, in the last few policies, we've seen that they have changed their forecasts and have been nimble about that, not stubbornly holding on to a forecast. So we saw a huge slash in inflation forecast today, 120 basis points lower than what they were in October. And I think that was the appropriate thing to do. All of us didn't foresee either this huge food price undershoot. I mean, the fact is we're not seeing any of the MSP increases in the food inflation data at all. And who would have guessed that between October and December you have a 30% fall in crude prices? So I think the first thing that I liked was that they've marked to market what the inflation forecast is. The second is they're being very open that they're going to be data dependent. That 4% is what they're after. If data undershoots 4% and the bias continues to undershoot, then all options are on the table. If inflation is above 4%, then they'll have to be in a long pause. So just as the Fed is indicating that in an environment of such tumult and so much uncertainty and so much volatility, all central banks can do is be true to their framework and be data dependent. A last thing I'll say is I think what's coming out also very clearly in the last two policies is that a tightening of external conditions around the world may not preclude the RBI potentially, I'm using the word potentially, from cutting rates in 2019. Ordinarily, you would think if the Fed is moving 4 or 5 times next year, which is what we at JPMorgan believe, there's no way an emerging market central bank can cut rates. What the RBI has made clear is a horses for courses policy, that policy rates will respond to domestic growth and inflation dynamics, and sterilized intervention on the exchange rate will respond to external uncertainty. And I think that will continue. So you could have a situation next year where food inflation is very benign. Headline CPI is below 4%. The RBI could contemplate easing then, even if the global environment is one in which the Fed is increasing rates. The exchange rate will only matter insofar as it affects your inflation forecast down the line.
Okay, I'm going to pick on a couple of aspects which both of you have mentioned. The inflation forecasts, are they sitting well with what you're forecasting? And given the deep slash, as Sajjid was saying, probability of underperforming this in actual inflation is, well, hopefully relatively lower now.
I would think so. I think our own median forecasts of inflation in H2 is probably somewhere in the middle of where they are pitching. So, I mean, so the 3.7 top range, I think it will be somewhere below that. And going forward is what I'm more worried about, because I don't think there is any prospect of either a rate change or a stance change in the next in H2 of FY19. What the forward 1 year ahead forward view of inflation, of growth, etc., is becoming far more critical in deciding policy. I'm very surprised that, and I don't think it's a little bit of an against the odds of the lower inflation. It doesn't quite sit well. Is they're maintaining that 7.4% growth? Yeah. Because that seems to indicate, and they've explicitly said that. I mean, that with the lower crude prices, that's an effective stimulus into the system. So if growth actually remains at the 7.4, I would seriously expect core inflation at least. I don't know how food inflation will behave, but core inflation at least will begin to, hopefully, I mean, that's what we would expect, that, I mean, corporate pricing power comes back into the system. The capacity utilization numbers that they allude to, I haven't seen the numbers yet, that they allude to, will gradually increase pricing for manufactured products and other services that we have seen. And that should take inflation up. And that's precisely the reason why the reduction in inflation for Q1 of FY20 is much lower than what it is for H2. Yeah. So that's the broad sense that I think this is more or less realistic. I think inflation will actually turn out somewhere above the midline of their inflation forecast.
Okay, Sajjid, that's the thing, right? So if one assumes that growth remains strong, demand-driven pressures show up on core, then for headline to remain soft, one is assuming that this extraordinary food price, disinflationary scenario will persist. Is that realistic? I mean, if it persists, then it persists amidst, sort of agrarian distress and continuing pressure on the rural economy.
The reality is that food inflation in India, or the disinflation in India, has persisted for the last 5 years. And I think one of the reasons why all of us have consistently overestimated headline inflation over the last few years is because at each point we thought that the food disinflation was transient and there would be some mean reversion of food prices. That mean reversion didn't happen. If you draw a trend line over the last 4 or 5 years, you see this sustained disinflation in food. This is good news and bad news. It's good news in the sense that it clearly suggests that there's been improvements on the supply side. Food supply management has been much better. But it also perhaps suggests that some of the food disinflation is because the rural economy has generally been weak, and now with food prices falling so much vis-a-vis non-food prices, the terms of trade that farmers have to confront is getting progressively worse. So there is sectoral stress. But the fact is, from an RBI perspective, the food disinflation has been durable enough that it's realistic to believe that this could persist for a while. I mean, we're sitting in December, and we would normally have thought at least cereal prices would rise in tandem with MSPs because that's what the government procures in some quantum. But even that hasn't happened so far. That's number one. Number two, of course, who knows where oil prices will go. But I presume these inflation forecasts implicitly are pegging oil not very different from current levels. And on the third front, I tend to differ a little bit on growth. My own sense is that the best of growth is behind us. I think sequentially growth forces will slow from here. I think, yes, banks are stepping in to lend to NBFCs, but from a flow of funds perspective, I think credit will still slow to the corporate sector because of tighter monetary conditions in the NBFC sector, and that's a headwind to growth. Secondly, I think the government is very serious about meeting its fiscal deficit target of 3.3%. But given some revenue shortfalls, I think we may need to see some expenditure compression in the next couple of months. So I think both the fiscal impulse will be tighter. You get some NBFC tightening. Yes, this is offset by the fact that oil prices are lower, and that's a positive terms of trade shock in the second half versus the first half. But my sense is growth will slow in the coming quarter. So the combination of slowing growth, oil at current levels, and the food disinflation sustaining gives us inflation forecast very close to what the RBI has.
What is your own sense of where growth will settle, Saugata?
For FY19, unfortunately, as Sajjid mentions, I have a feeling that we'll see a further growth slowdown. You've already seen growth slower than what we had expected for Q2, and that's before all the credit problems came in, the liquidity tightening happened. So my own sense is that for Q3, you're likely to get a significant slowdown of growth, and they're 7.3 or 7.4% that they're pegging for H2. I think it will come in significantly lower, maybe 6.5, 6.4, 6.5. So overall for FY19, I cannot see growth more than 7, GDP growth more than 7 to 7.1%.
Okay, so maybe they'll adjust their numbers a little bit later. Well, there isn't much time left, but maybe in the February policy. Sajjid, on the liquidity front, I think the market took a fair amount of comfort with Bhattacharya saying we'll continue with an elevated level of OMOs. Good enough?
I believe so. I think, again, there's been a lot of consistency here. Back in May, in fact, when we looked at that very strong currency and circulation numbers, we had believed that this would be a year with a lot of OMOs. I think there are two parts of their liquidity policy. One is to ensure that the weighted average call rate is close to repo, which they're able to do through term repos. And the second is very clear that durable outflows, which means currency in circulation or dollar sales, will be met by durable inflows, which is open market operations and dollar purchases. And I think what you're seeing this year is kind of the perfect storm, because on the one hand, the RBI was selling a fair amount of dollars in the first half because of the stress on the balance of payments. But the other part is that you've seen a sustained run of high currency in circulation. That growth rate is still very strong compared to the last 2 years. So if the RBI were not to do these OMOs, headline liquidity would easily go close to 1.5 or 2 trillion. And that would be against their liquidity policy of trying to keep the headline close to neutral. So I think you have no choice. There are only two ways to create base money, either net domestic assets or net foreign assets. Hopefully there'll be some dollar purchases because oil is lower, the current account deficit is narrower, and the BOP may well be in a modest surplus, but the bulk of that will have to be done through OMO. So really no surprise on that front.
Saugata, the liquidity question was also more important in the context of what's happening on NBFC. So I think once again they've reiterated that, look, system-wide we're doing whatever we can. And then, the other problem is a separate issue which they're tackling through slightly micro measures.
So liquidity, I'm more pessimistic than Sajjid. I think liquidity, the situation will worsen significantly in H2. What remains of H2. Quite apart from the currency in circulation, which in a pre-election mode is likely to come off even more. But more than that, I think the key dynamics of liquidity, other than what the RBI might need to do in the forex market, sterilization of forex purchases, I think what is really significantly of concern is now government balances, which is one of the largest part. I mean, in H1, it was the very high government spending. Government spending has been enormously, significantly higher in H1 than it used to be in the past because of the front loading of expenditure. So that has kept liquidity in surplus despite all the other factors that were creating liquidity problems. In H2, so either of two things can happen. One is that they can begin to spend more because, their revenues will be backloaded into the second half. So they can either spend more, which obviously means a slippage in the fiscal deficit because higher spending will lead to that increase in spends. Or else they will maintain balances with the Reserve Bank of India, not spend as much, take the revenues, keep it in the Reserve Bank, and that means a bigger liquidity problem. So I think from what our own initial calculation seems to suggest, that the 400 billion odd monthly OMOs that the Reserve Bank is planning is not adequate to address the liquidity problem. And particularly now with the credit problems that are now likely to, as Sajjid also mentioned, that with NBFC and even banking credit to a certain extent beginning to come off with a portion of the banking sector not yet in place to deliver credit. So the liquidity situation needs to be dealt with very, very significantly. My own sense is, forgetting about microstructures of my sectoral approach to liquidity, as the Reserve Bank mentioned, I think the system should be made much more liquidity neutral than it is currently in, and then hope that some of this liquidity actually goes to the from a systemic liquidity perspective to an operational liquidity where actual credit, where the demand for credit is they get liquidity, which is what some of the current squeeze is. That percolates, the overall systemic liquidity then percolates into the sector liquidity.
So you wouldn't be opposed to a CRR cut? 25, 50 basis points.
I don't frankly think a CRR cut is, I wouldn't advocate a CRR cut. I think there are enough systemic risks to keep that liquidity buffer intact. I would argue for further an increase in the quantum of OMOs that the Reserve Bank, maybe 600 to 650 billion OMOs every month rather than the 40 billion that they're committed to. Let's see what happens.
Okay, Sajjid, just a response to Saugata's point, but also, did you get a sense that the RBI is adequately on top of the NBFC situation? Again, not in the sense of, micro measures, but, they talked about the fact that bank plus NBFC credit is still well ahead of last year. Growth numbers look strong. They didn't, say much about the growth impact of a sort of a slowdown in the commercial, in the flow of commercial resources. Are they building a slowdown in the NBFC credit situation in the second half at all, building into their numbers?
Hard to say what they're building into their forecast. I think what policymakers will take comfort from is that banks seem much more inclined to step in and pick up some of that slack, right? So the issue is here that NBFCs don't have the liquidity, banks have the liquidity but not the capital, but there's a great synergy for banks and NBFCs to work together. And I think the fact that if you just look at the credit growth data over the last 2 years, banks were already a big financer of NBFCs. I suspect that's going to continue both in terms of buying securitized assets of NBFCs and lending to NBFCs. Now, I think the prerequisite to that is banks may need more capital, and I think hopefully the government will recapitalize public sector banks in the coming months, so banks are more emboldened to lend. Now, all of that said, I'm not sure the offset is complete because I think some of the tier 2, tier 3 NBFCs may not be able to access growth liquidity very easily. There is a reassessment of risk in that sector. And you don't have these are not perfect substitutes. I think NBFCs have some advantages in origination that banks didn't have, which is why the NBFCs existed in the first place. So I think we will see some slowdown. Perhaps policymakers believe the early evidence is that it may not be as much as that. Number two, even if there is some slowdown, I guess the mitigating factor here is with oil at 60 now versus 85, you get some positive growth impulse from that. And hopefully, I presume that's what's behind the fact that the RBI has not reduced its growth forecast. So all told, while growth could slow, the growth concerns today are less than what they were, I would presume, in early October.
Okay. Two more questions before I let you all go, and sort of not directly linked to monetary policy, but Saugata, would love your views on linking of lending rates on the retail and SME side to external benchmarks. What's the big picture there that we need to keep in mind?
So this is good. I mean, I'm not talking from a representative of a bank.
As an economist.
As an economist.
Yes.
So I mean, they have been talking about this for a long time. That there needs to be more transparency for SMEs and retail borrowers from banks, because there's a certain asymmetry in negotiating power and transparency. So I mean this is good, and not just this, coupled with the other measure on working capital and term loans being linked together. I think this induces greater market discipline, greater liquidity management, greater risk management, finer pricing, etc. This can actually serve to develop the term repo markets, because remember, whenever you are looking at a granular level of pricing, and this is obviously a pricing issue that comes in order to protect NIMs from fluctuations in the markets, you'll have to do much better and stringent liquidity management. You'll need to do better risk management. You'll need to use products, risk management products. You'll need to bucket your loans. You need to shorter term loans. So the term repo loans that we have been struggling to get moving, this might actually have a positive impact on the term repo markets. From a corporate point of view as well, from the other, I mean, I'm talking about the working capital and the term loans. Yeah. So corporate will need to do much better liquidity management than they have in the past. So, I mean, one part of this liquidity story that we had been talking about is the provision of liquidity. The other side, the obverse side of this, is better liquidity management. And these are the measures that are designed to create that, incentivize that liquidity management.
Sajjid, how do you see this, particularly the former, in terms of pricing being linked to external benchmarks? Bigger issue is transmission, which we've, as I keep joking, it's my career has gone by without a final answer coming to that.
Well, I think you got a big answer today. I think it's unambiguously positive. Completely agree with Saugata. I think A, it brings much needed transparency, and B, I think it will expedite transmission to have these transparent external benchmarks to which you link. Now, banks may say that this at the margin increases interest rate risk because my asset side is tied to an external benchmark and my liability side is more sticky or locked in. And this is where, as Saugata hinted, you have to use risk mitigation tools and begin to hedge that interest rate risk. So I think this is a very positive step in the right direction. And the more transmission that central banks can be confident of, then these long and variable lags of monetary policy that we talk about, by definition, get shorter and less variable. I think it just helps the whole system.
All right, just ending the discussion by asking you all what you think the rest of the, the current financial year and the first half will look like from policy perspective. So would you expect, as things stand, no change in rates, sort of a pause period which would be extended at least until the first quarter maybe of next year?
So given our current understanding, and our current understanding is somewhat imperfect, so given current understanding, I would expect a long extended pause. I do not see there being too much for the near future at least. Let some of the events in the first half of FY20, let's get over those, the political considerations, etc. Let's get past that. And then we'll begin to see some investment coming in, at which point in time corporate pricing power might actually come back. But till that time, I see no change in rates. I don't think there will be a drop in rates. I don't think there's too much possibility of a rise in rates. And globally, I'd expect a slowdown to become evident in the latter half of 2019. So that will also, I think, inhibit any significant increases in rates in India.
Sajjid, your call for the next 6 odd months?
I think George Maynard Keynes said, right, when the facts change, I change my view. The problem is the facts are changing so quickly around the world and domestically that any view is, I think, short-term in nature. Exactly. So I say there are a lot of ands here, but if you presume that things are where they stand, food inflation remains benign, oil prices remain close to 60, growth slowly tapers off. And, globally, two things happen. We're clearly seeing growth inflation dynamics around the world change. Global growth seems to have peaked and is going to slow, led by the fact that the U.S. sugar rush of mid-year will result in more normal U.S. growth. That should exert some disinflationary forces globally. And these geopolitical risks, both related to Iran sanctions and the U.S.-China trade war, at least at the margin, seem to be a little bit less. So making all these assumptions, I would expect that the next two prints will be very benign. I think November CPI is tracking close to 2.5 to 2.7%. December could be close to 3. So if the RBI enters the February meeting with this kind of trajectory, and the government sticks to its fiscal deficit target of 3.3%, I won't be entirely surprised if the stance in the February meeting changes to neutral, keeping all options on the table. What happens thereafter is purely a function of the data. I think this MPC is prepared to move in all directions. Based on whether the outlook for inflation is below or above 4%. Right now, our view is that expect a prolonged pause because inflation should be close to 4% for the foreseeable future.
All right. Thank you both so much for joining us on this quick coverage of the Monetary Policy Review. You're watching Bloomberg Quint.